I'd like to spend a moment and talk about how we can use defined tools to hedge portfolio risk in a high vol environment. Many people I talk to, many friends, many advisors that I've known over the years basically say that you can't really use any type of hedging after the markets have already become volatile. And that's actually not true. There are trades that are available to within a portfolio framework that you can use that actually still work even though vol is very high. And so what I want to talk about over the next couple of minutes is what are some trades you can think about that you can actually put inside your clients' portfolios that can actually hedge if the market keeps going down without trying to time the market or putting more money in debt and hoping that bonds essentially hedge off the market volatility and the equity volatility we've seen. A couple of good trades that we like are trades that take advantage of what we call the steep skew when markets are volatile. And all that means is lower priced options are more expensive on a relative basis. They have a higher volatility, which affects prices of options, than higher strike options. Well, to buy a long put in a high volatile market is far too expensive. Even to hedge off risk for a month or two, the cost you would pay for owning a long put in a high volatile environment would be far, far too expensive. So what you can do to mitigate that cost is you can actually use a put spread. In other words, where you can buy a long put and then sell a further out of the money put. And that's actually leaning up against this, what we call reverse skew. You're actually buying an option closer to the money and selling an option further out of the money. And the option that you sell further out of the money, yes, is going to be less expensive, but because it has a higher volatility, it's actually going to be more expensive than it should based on how far to the money it is. We call that moneyness. So put spreads are much more valuable in a high vol environment than just a long put. The version of a put spread that we like and we use in our portfolios is we actually do a bit of an overwrite in that put spread. So what I mean by that is you might buy 100 puts, but then you might sell 110 puts or 120 puts that are, say, 1.5 or 1.75% out of the money. That's called an overwrite or a light ratio. Now, why we like that trade is because that trade becomes less expensive. One of the things that we look at when we trade options as a hedging tool is we want to get about 10-to-1 return on capital. So if I put $4,000 into a hedge, I want to be able to make $40,000 if the market should come down. All the strategies that we have talked about in my stock replacement strategies, or all the strategies that we've talked about in the videos or the white papers, are really using options or using various types, whether it's the S&P 500 or whether it's VIX, to really hedge risk, to manage risk within a portfolio framework. We feel that's where the value is. Now, we have a series of educational webinars that we give from time to time, and if you're interested, go to our website and definitely sign up, and we'll let you know when the next webinar is so we can social distance and we can at least give you some knowledge on how maybe think about using options within your portfolio to manage risk for your clients instead of trying to time whether the market's going to test the lows of late March or whether the market is going to continue to rally as this virus or the economy comes back. Because the truth of the matter is, market timing doesn't work. And I learned a long time ago that diversification isn't mathematically perfect. So our attitude is, can we use more of the defined way to run money? It's really thinking about options, not from the short side, not from selling calls, not from selling puts, not saying that those strategies aren't viable. We just see optionality as more of a defined way to manage risk if you can figure out how to reduce the cost of holding long optionality. And I believe we figured that out. So take a look, and if you're interested, do sign up for our next webinar, which will be coming to you soon. Thank you.